Thank you guys so much for coming to our March fundraising workshop. I flew in last night from New York, and this is our first time bringing the fundraising workshop to San Francisco, the cerebral valley, home of AI innovation. Today we're going to really dive into some new content. I'm excited. Our team has been working on to debut around how do you really think about going from seed to Series A in the AI fundraising cycle, and what are kind of proprietary macro data that we can share to help you guys really contextualize and leverage your fundraising approach. So this is kind of our fundraising 201 update to how we've been doing pre-seed and seed stage funding, to more thinking about like, now that you have an existing institutional round, how do you really think about going from that seed to Series A inflection point? Quick introduction about SVB. We've been supporting founders and VCs for over 4 decades now, and we are now under the Strength and Stability of First Citizens, where we are leveraging our kind of unique marketplace of founders who bank with us, as well as investors who bank with us, to really create this founder and builder ecosystem where we can connect you to other best-in-class founders and builders in your vertical, as well as thinking about what are strategic partners and investors we can connect you to really supercharge your growth from pre-seed to Series A. We are here in New York, in San Francisco, in all the large tech hubs. And, I would say the best part of working at SVB is our focus around helping founders through value beyond banking. So instead of just thinking about us as solely a banking partner, we want to be the cheerleading team that surrounds you with other experts, other founders, investors, and partners who can really help you think through deep problem sets. And that is really, the SVB ecosystem. So quick introduction about myself. I lead our startup banking practice in New York. I used to live here in San Francisco for the first formative decade of my career. I started out as an operator working at early stage SVB clients like Sunrun, Sigfig, O-Power, and then I moved my way more into the product world, where I touched upon a lot of AI, powered consumer products at Facebook, Instagram, and Tumblr. And right now, my role is really thinking about if you are an early stage founder, how can we really help you think through the fundraising process, the company building advisory, as well as this larger connectivity to the SVB ecosystem, whether or not you're an SVB client or not. Like, we are here as a resource for you to really help you go through that entrepreneurial journey so you're not alone. And I've been on both kind of the operating side as well as the investing side. So I've got a lot of deep empathy for the founders who are in this, really difficult market right now, which we'll kind of touch upon a little bit more. So feel free to reach out to me as you're thinking about, starting your company, starting the fundraising process, and really thinking about what SVB can offer you as a banking partner, as well as an ecosystem partner. And I am today joined by Liz. So I'm going to pass it over to you for a quick intro.
Awesome. Thanks so much, Bo. It's great to be here. My name is Liz Cahill. I've been at Silicon Valley Bank for 7 years now, and I've spent the last 2 as a researcher on our market insights team. So we, try to bring some clarity to the notoriously obscure private markets world by diving through multiple different data sources, PitchBook, macro Fed data, Preqin fund data, other proprietary data sources. So we use the SVB Hive Mind. We interview a lot of thought leaders and bankers and founders who are in this ecosystem day to day and synthesize that into hopefully digestible and fun to look at and read insights reports. So I'm here with a few slides today that my team created to add some context to the overall macro fundraising environment. And we also did put together a few slides on AI.
So one announcement is we're actually going to be debuting a state of AI report for pre-seed companies focused in New York later today to kind of dovetail the fundraising workshop. So you'll be getting some sneak peek into how we're characterizing the New York AI market. And we are bringing our guest speaker, James Currier, as a AI expert to really share how we're really thinking about the fundraising approach for Gen AI companies. So I'm super excited to have James here. James is a 5-time serial founder, expert on network effects, and general partner at NFX. In 2015, James co-founded NFX, which is a $1.6 billion early stage VC firm focused on network effect businesses. Before becoming an investor, James co-founded one of the internet's first user-generated companies, Tickle, in 1999. Tickle was acquired by Monster in 2004 for $110 million. And James went on to start 2 other successful companies, Wonderhill, which merged with Kabam in 2010 and sold for $800 million, and Jif, which merged with Castlight in 2017. So we are super thrilled to have James here. I actually met him at an AI Axios roundtable that we hosted, and he has a lot of amazing frameworks, data, and insights, and is also a writer who I'm deeply inspired by. So
thanks for having me.
We're very excited to have you. And is it on by any chance?
How's that?
Yes, we can hear you.
Glad to be here.
Yes.
Great. So we'll be diving into kind of the data first of the fundraising workshop, and then we'll move into more of the tactical know-hows, like what are actionable insights you guys can walk away with. And then we'll be ending, with any questions in the room and allow some time for networking as well. So quick kind of preface around how we structure the workshop here. We really want you to walk away understanding why you are uniquely positioned to start your company, to fundraise, and be a venture backable business. Why is the market timing relevant for you to be entering in with your particular solution? And also, why is the problem so acute and large enough of a market for you to enter? So this is how we really think about generating venture scalable returns. We oftentimes kind of pre-qualify our investors, and our kind of advice is do you want to be on the VC backed path, which is all about scalability, generating 100x returns for a fund, or do you want to be more on the cash flow, sustainable path? And that's something to really kind of clarify for yourself before you go down the venture fundraising path. Some disclaimers here. Obviously, the data here is going to be more of an average, market medium. This is not something that we are saying, is prescriptive to you. Just know that fundraising is not a one-size-fits-all approach. And we do leverage a lot of our data in our own regions in New York and San Francisco. And obviously, depending on where you're calling in, I know a lot of our virtual attendees are in other markets. Know that, this is more of a overview than an individualized, tactical advice for you to go into fundraising. So to kind of kick things off, I'm going to pass it over to Liz to really help contextualize the current macro market, to really think about, what is the landscape you're walking into as you start your fundraising process.
Thanks, Bo. Well, we are going to start from the beginning. We're going to pull all the way back to look at 25 years of VC investment data. And there has been a lot of ups and downs, but overall, we've seen a maturation of the asset class and also a lot of growth in the space. If you're a founder right now trying to fundraise or an investor in the space, there's been a noticeable pullback in funding since 2021. And 2021 was just a really massive peak. Just, looking at this graph, post-pandemic or during the pandemic, the Fed dropped interest rates to 0%. A lot of private equity firms and other non-traditional investors entered the venture space to get in. And it was a place that was seen as a way to get alpha, get into the markets. Public markets were not as interesting at the time. So we just saw this flood of capital into VC, and startups raising in 2021 just received massive valuations. I've heard anecdotes of companies not even trying to raise, being approached by investors, offering them money. So 2021 was really just a massive peak. As a result of zero interest rates and other factors, including the supply chain during the pandemic and other things, we had a massive rise in inflation. And the Fed said, we're going to start raising interest rates again. So we saw this sharp rise of interest rates, the sharpest we've seen since the 80s. And that just kind of acts as a brake on the economy, pulling things back. Also, all those LPs, limited partners in venture funds, started to feel very exposed to venture. Their public market portfolios had contracted a bit, so their slice of their asset allocation that was in venture started to look really large. You also had, the FTX debacle and some high-profile cases where there was a lack of diligence, and it became very apparent. So a lot of funds said, we are going to move more carefully, more diligently. We're going to slow down. So that's a very oversimplified explanation, but there's been a desire to slow down in the venture space. There's still massive dry powder. We have a record amount of money raised by funds that has yet to be deployed. But I always like to say, a VC's dry powder, that's not cash in their bank accounts. They have to call that in from their LPs, their limited partners. So they're being very careful before they make those capital calls. They really want to make sure that they have something compelling to invest in. And their LPs are trusting them to make good calls. So we've seen about a 64% pullback off that peak in 2021, which looks really dramatic if you look at this graph, because 2021 was so high. But if we go all the way back to the dot-com era, there was actually an 88% pullback. And that was because, the dot-com bubble was concentrated in tech. So it was, leading up to that, that was I think one of the first big tech booms that, reached the public consciousness. Everyone became a dot-com. We had a lot of really early stage Series A companies debuting on public markets that, would not fly today. And that crash resulted in a big pullback and kind of a quiet period for VC where things slowly recovered. And then we had the great financial crisis, and we saw about a 43% pullback between 2008 and about 2009. However, during the great financial crisis, things recovered a lot quickly for tech. There was a lot of innovation at the time. We were seeing the rise of mobile and social media hitting mainstream at this time. I think this is about when everyone could get a Facebook account. So you didn't have to be a student. So the landscape was really changing during this time period, and tech was becoming, a much larger part of our, economy, basically. Every company was becoming a tech company. So this was a big inflection point, and tech kind of drove a lot of that recovery. So looking at the 25-year growth rate versus the rate of recovery from the great financial crisis and the dot-com boom, we've kind of mapped out sort of three rough scenarios of where VC could go. We don't have a crystal ball, so we don't know exactly how things are going to go. But if we're looking at a great financial crisis scenario, things recover and go back up a lot quicker. .com, things take a little longer. And then you have a 25-year, compounded annual growth rate sort of sitting in the middle there. So this is sort of just looking at the past to try to map out where we might be in a few years based on past cycles. And then in response to this, many startups are just cutting back on their spend. So this area chart shows the percentage of companies that are improving net burn year over year, AKA cutting costs. So we saw a big jump during the COVID-19 pandemic. In the beginning of the pandemic, when things were really uncertain, we saw a lot of cost cutting for startups. And then we're also seeing this now as fundraising started to contract in 2022. A lot of startups are cutting their costs. And I think this is really important for early stage companies because, revenue, you might be pre-revenue and you're not going to have, the same, I guess, ease of fundraising in all cases as you did in 2020, 2021. So as that time between rounds increases, conserving runway and being really diligent about managing that has become more important than ever.
So within AI, like we've been seeing this watershed moment happen around 2021 when ChatGPT became more in mainstream consciousness and AI was kind of just in everyone's faces. But if you look at the different trends of platform shifts within mobile, within AI, within the .com and clean tech and Web3, like the crescendo that led to 2021 had been building for quite some time, like even since the 1990s. So very much like of what emerged into the mass consciousness of like everyone is now becoming an AI company was happening more after 2021 due to OpenAI's kind of paradigm, and I wouldn't say paradigm, more of a zeitgeist shift in terms of how people think about AI. But if we look at the historical data around how companies have been going mobile, it's very analogous to how every company now is an AI company. So around like 2006, 2009, when the Facebook kind of started pivoting from like a native desktop company over to mobile first, that was like a huge concerted effort for startups to also build their mobile app. But if you look at every single mobile company that emerged, especially, if we're looking at an Instagram or a Pinterest or an Uber, like a lot of these companies, like there were mobile app native companies, and then there were desktop companies that retrofitted the mobile technology in there. So similar to that framework, we're looking at AI companies where there's a lot of native AI companies, the picks and shovels, the foundation models, and then there are more of like the applied AI companies that are kind of retrofitting the AI features and products into their business models. So with that, we're seeing this boom of like every company is an AI company, but we need to also look at where they are on the Gen AI tech stack and whether or not this is a native AI company or an applied AI company. And I think this is where looking to how the mobile shift happened is very instructive for us in assessing the AI revolution. From a VC kind of zeitgeist enthusiasm standpoint, we are seeing that 1 in 4 funds in 2023 that have announced a raise are considered, categorized as an AI fund. And about 60% of those funds that have announced they are fundraising are categorized as an AI fund in itself. So I think this is the interesting piece is like, there's a lot of LP exuberance in terms of funding AI companies, but how we're seeing these funds emerge as AI companies, like we have to really coach and help our founders think about like what is so differentiated about one AI fund from another, and like what are the different values that value add like mechanisms that these investors can be adding on your cap table. We're also seeing within the net deals that are being funded in venture, it has been dropping by 64% overall, but the net amount of dry powder has been increasing since 2021, allocated for just AI companies. So even though VCs are doing less deals, as a total, the AI category has been increasing in terms of funding. So I think that is kind of a silver lining for a lot of AI founders is like you have proportionally more dry powder to go after in terms of how these funds are allocating capital.
Yeah, and I would just add, that graph we saw where overall VC in the US is down 64% off the peak. That's not the case for AI companies. I mean, we saw between 2022 and 2023 funding actually go up. It's still not 2021 levels, but we did see it go up, even though deals have gone down. So that just means fewer companies are raising larger rounds. And also, I do want to point out, this is a little bit nerdy, but on the top right, you see the R squared for AI VC and all VC. And basically, like pre-chat GPT, AI deals were much more closely correlated with the overall market. So an R square of 1 means things would be perfectly correlated with VC. So if VC went up 10%, AI VC would go up 10%. So it was reasonably close. But then post-chat GPT, that R squared has gone down, so it's less closely correlated. So we're seeing AI really pull away from the main the main like VC cycle. And you see that here, that's really represented in the bottom left graph, where even though the overall market's down 64% in terms of like funding dollars being deployed, that's not the case for AI. So I think that's a really interesting point. If you're an AI founder and here trying to fundraise, you see, oh, the overall VC market is down, but that doesn't apply as much for AI companies. There's a lot of activity, there's a lot of investor interest. So it's a bright spot in the market.
I'm going to turn it over to James to kind of comment on the mobile revolution graph here and how that, can be analogous to AI companies. Like, I know we were talking about how every company is an AI company. It's essentially like similar to going mobile. How do you counsel like founders think about learning from the kind of mobile 2000s boom as an AI company today?
Yeah. So one of the things we noticed was that when the mobile, we had the browser and TCP/IP come in '94, and almost 0% of that market that was created was captured by the incumbents. That's what created that enormous bubble and the enormous wealth. And then we get the mobile technology that comes along. That's the next paradigm shift 14 years later. And about 93% of the value created in the mobile revolution was captured by the incumbents. Only 7% was left for founders like you and investors like me. 14 years later, along comes AI. And it feels, as you go down 101 with Brex saying AI first and Okta saying AI first, all the incumbents are adopting AI very quickly, even faster than they did mobile. And so I suspect that it's going to be 96% of the value is going to be captured by the incumbents. Right. So the first boom from 94 to 2013 was the big one. And then those of us doing startups are having a harder time capturing more of that value going forward. I think the same thing's going to happen with AI. And I think to the point is, what's an AI company, what's not? I mean, all these companies are saying they're AI companies because that answers the question, why now? Why should you invest in my company? Why should you use my product? So it makes sense that everybody becomes an AI company. Same thing for venture firms. They're all saying, well, I'm an AI venture firm.
Yeah.
Everyone's an AI venture firm. Like if you're a biotech company, you're investing in AI now. Because if you don't, there's the question of why now? Why would your venture fund take money from an LP now, rather than just giving it to somebody else who's already been investing in the space? So I think it's hard to tease out of the data what's an AI company and what's not, and we just have to be careful. I think there's some great graphs in here showing how it might break out, and there's lots of different ways of dividing it up, but each should provide some insight as to how you navigate.
I also love the idea of starting a 101 billboard index to track the trends. Somebody should start doing that.
Yeah. I'm sure there'll be some interesting correlations.
And, coming off that last slide, like just diving deeper into some of these layers of what is an AI company. There's a few different ways to sort of slice it. The way we do it is looking at starting with the underlying computing layer, then going on to AI models, which you have a wonderful article breaking that out even further. And we have that slide here too, which is great. Then you have vertical applications and robotics, like kind of on the top, those light blue. That's sort of your software and hardware application of AI using those foundation models. And this graph can be on the top left. It's a little bit tricky to read, but you can see the aggregate valuation and aggregate VC raised. The vast majority of that is going to AI applications. So computing is a much smaller space. There's fewer companies making GPUs and semiconductors. Is a very specialized. That's very specialized machinery. Very few people can make that. But apps is the more democratic space in AI. Going down to this bottom right chart, I think this is, off your point about how like most of the value is being captured by large companies. You see here, the largest tech companies in the world, are invested in or partnering with or building or acquiring some of the top companies in the space. And I think the biggest limiting factor in AI is the computing. So of course, the largest cloud providers basically, take most of the share of, are concentrating power in this space. So Microsoft, Google, Meta's not on here, but they are building their own tools. So a lot of it's flowing back to big tech. However, you do see at the seed level, it's like over 25% of US seed deals are in AI right now. Most of them are in the application space. Not as many are in the foundation layer. And then looking at investment, seed's the place to be right now, basically. The early stage, this is a trend we saw overall, not just in AI, but coming off the 2021 funding boom, you saw as things pull back, the early stage became much more attractive to investors long term because seed stage companies didn't have those sort of gluttonous valuations of the prior few years. Seed was kind of like the fresh start. Okay, we can start off and have better business practices. Some of the excess of the prior decade was not present in early stage companies. So that became a much more attractive space for investors. So while the overall market valuations are pulling back, fundraising is pulling back, seed is sort of going against that trend.
Yeah, and some other points to make. This is a very dense slide. I think you should have almost 4 slides for,
I
for
know.
this one. But if you go to the lower right, you've got to realize the mechanics of this. In the same way that you realize the mechanics of your fundraising, there used to be 250 VCs doing my job back in the beginning of the first chart. There's now over 31,000. If you go to signal.nfx.com where all the VCs have profiles, there's over 31,000 of them now. And they are trying to make their careers just like you're trying to make yours. And there's a dialogue in that marketplace. And 20, 30 years ago, there wasn't. There was just a few venture firms. But now there's hundreds, and they're all trying to figure out what to do. So they need to jump on AI to move their careers forward. The same thing is the mechanics here with these large companies. Oracle has 50,000 salespeople. They need to hit quota.
Yeah.
They have existing relationships. They have installed software. They need AI slides in their decks. They need AI products to push down the channel, and Oracle needs to provide that to them. Same thing with Microsoft, 25,000 salespeople who have families. They need to feed.
Yeah.
This is the mechanics of it. And so this is what, as a startup, you're up against, and why these guys are all jumping into it. And then in terms of the seed valuations, they are going up because the later stage guys don't want to get into the later stage companies because they're spending too much capital. They haven't found product market fit, even though they're in Series C.
Not many exits.
There's not many exits.
Yeah.
There's, the big companies aren't allowed to buy big companies anymore. So the big guys are now going down into seed. And for them, $80 million valuation is typical. So for them to pay $30 million for a seed company is nothing. It's like, it seems like a steal, even though that's just the psychological mistake they're making. And so you're getting a lot of pricing pressure up on the seed stage right now.
Yeah. So great time to be an early stage founder.
Yeah. I also want to spend some time on how to think about like corporate partnerships and investments. I think that, to James' point here around how incumbents captured like 93% of value in mobile, like we're seeing the incumbents, like Microsoft, Google, NVIDIA invest in AI companies, especially on the model level, that can also become clients of their compute power offering. So like as you start thinking about navigating corporate relationships, whether that be partnerships for distribution or investments, we do want to advise you to think about like what is the value that you would be able to get out of these types of corporate relationships early on in your journey so that you don't short circuit the potential value for your company as these larger companies are moving in to retrofit AI. So is this more of a service provider relationship versus a capital investment relationship? And I think this is where investors like James, who have seen the value chain in previous cycles, can help advise how AI startups really navigate the need for AI innovation too.
Yeah, I don't know how many times in history it's been the case that the top 7 or 8 market cap companies in the world all have the same priority. The number one priority at the board level of all of these companies is AI. That's what they're talking about. That's where their budgets are going. And as a result, they have created a lot of new minds that can destroy or help your company. 15 years ago, you would raise money from VCs and then you would either sell to one of these big guys or you would not, and you'd go public or you'd figure something else out. Now, because they have venture arms, now because they have more biz dev people, now because they have larger M&A departments, there's a myriad of options that will occur to your company as it starts growing, and any one of which could sort of reduce your exit value by 80%. There's a lot more things to navigate as it relates to these incumbents that there were 15, 20 years ago. And there's a spectrum. So for instance, if you want to raise money from PayPal Ventures, they're in a different building. They have different incentives. It's just the branded. They're all looking to build their venture careers and leave and go work for Excel or NFX or Sequoia. That's a very different relationship with PayPal than if you do something with their biz dev group or with their sales team or with their M&A group. And so where you're going into each of these companies matters, and then what the relationship you're looking to get out of it ends up mattering. And so it's very complicated, and there's a whole spectrum of ways that you can play with the incumbents now that didn't exist even 15 years ago.
Yeah, I think that's the value of partnering up with great investors like you. So you understand there is a lot of choose your own adventure paths to take down, but each path has their own significant trade-off too. So you want to be making sure that your investors on the cap table can counsel you so that you're not, short-circuiting the net value of your company. So I think, in terms of how we think about what is AI and like what company constitutes an AI company, like thinking about the tech stack of where the AI startup that you're building falls in is really helpful to navigating, where which VCs to also talk to. So we joke this is like our coronavirus diagram of AI company, but really if you think about the different layers, the kind of layer 0 is very much the compute infrastructure. So we're talking about like the semiconductors, the hardware companies, the NVIDIAs, AMDs of the world that are powering the net compute power for AI companies to build on top of. That's going to be a smaller, subset of AI companies. And then from there, you're building, on top of like the picks and shovels, the foundation level AI companies, similar to OpenAI, Anthropic. And those are going to be the ones that are general models that other startups can build on top of. And then kind of adjacent to that are the more autonomous, machines, hardware companies, the Waymos, the self-driving cars that are powered by AI. But I think that the net focus right now happening within the AI boom of every company's AI is really spent at the vertical applications, the top layer, where all of these companies are creating their own LLMs or localizing, their own data, creating more narrow specific data that they can build on top of the foundation models. And this is where every company is now becoming an AI company. So if we think about where the opportunities lie for you going into whether it's a red sea market or a blue sea market, like really think about where you are on that AI tech stack. And the different kind of levels here also overlap with NFX's approach to the 5-layer Gen AI tech stack. And I'm curious, James, like when you're looking at the 5 layers, like where do you see the most opportunities for network effects, for commoditization, for being able to kind of create more stickiness within the AI environment?
Yeah, this is a diagram. So I love the diagram in the last slide. And there was another diagram you made with the 4. Look at all the different charts breaking down these markets. There's no one chart that shows you where your company sits. I published that a year and a half ago. And I would make modifications to it now that the market's been evolving. But in general, what we were looking at was a lot of, on top of the hardware, we could have put the hardware down there. And, this is missing sort of access and security and, data buying and all that sort of thing. But basically, the data network effects of the general AI and the specific AI models, I think, are difficult to maintain. So I think that the way OpenAI is going to maintain its preeminence is through scale, not through actual data network effects, because the open source models are going to catch up to it within 8 or 12 months every time. The hyperlocal models, these are the idea that you're going to get into a corporation and run their models for them, which is, it's unclear who's going to end up doing that. But that's a little more sticky because I, as Nike, want my photo maker trained on my data and the way we do photos at Nike. And who's going to run that model for me, that sort of thing. And I'll pay them an annual fee to do that. And then you've got your operating system and API layers, which is typically where you get your network effects, which is what OpenAI has tried to do by opening up all those GPTs so people can build them. And they wanted to be that API layer. Everyone wants that layer because that's where the network effects are and you get very sticky. And then the applications, like any software application, don't necessarily have network effects or not. And just using AI doesn't necessarily give you more or less. You still have to build them with defensibility in mind, either embedding or, where you stick your software into a company and they just can't rip it out because it's in their workflow and it would just cost too much to change all the people's behavior, or through network effects. And so we're looking mostly at the top two levels for looking for real defensible businesses. The other thing is that the ones on the lower part require a huge amount of capital, and we're seed investors. So our typical check is $3 million, which is a drop in the bucket for processing for some of these models. Now, going forward, I believe that you're going to see a lot of different approaches with the math to lower those costs of training by 100 or 200x. So the compute might not be as much of an issue going forward, and those costs of training models might not be as much of an issue, but that'll all play out in the next 24 months. But yeah, I would make modifications to this now, but yeah, this is held up pretty well in terms of how we invest.
And I like how you kind of double click and go deeper. It's not just like a model, like there's different types. Yeah. Different flavors.
Well, there's going to be different business models and how you sell and who you sell to and whatnot. But in general, we're pretty skeptical of the data network effects. And we've written about that. So if you go to Google and just type in data network effects, the first article is our article analyzing what makes for a data network effect or not. It's a good read if you're in the AI space.
I think level 4 is also interesting, layer 4, because you are creating interoperable systems and APIs so that even at the lower levels when all the models are changing still, like you could be the GitHub for X, So I think that's where there's a lot of
And that's what's happening now, as you all know. I mean, most of the successful companies at the application layer are switching out all the AI models for cost and performance or focus or clarity, and it's going to continue to happen. I think it's only through Microsoft's massive Salesforce and embedding that you're going to see OpenAI not just get ripped out of everything. There's no reason to pay very much money for it at all.
Right. So where we can help you navigate is like if you are a seed stage company thinking about moving over to the Series A side, to really think about how you are distinguishing yourselves as a potential company for a VC to invest in. At the seed stage, it's a lot of pitching the company more around the people, like the product is still early, you're still prototyping, there's not a lot of revenue or traction to go off of. But here is where like things get a little bit murky, because at what was traditionally seed is now, the metrics are shifting in terms of the expectation for you to be pre-market, product market fit is actually starting to track more towards what a Series A looks like. And this is where we want to help you think about, are you raising a seed? Are you raising a seed extension? Or are you raising a Series A? And the goalpost for how you think about like each of these life stage has really shifted as well. So in terms of how we map out the different ways for you to fundraise, at the seed stage, we're traditionally looking more at like the narrative of the company, the founding team, why you're uniquely positioned to tackle things. But investors are also asking for a lot more data at the seed stage, especially around market adoption, the how many users, the amount of design partnerships you are engaged in. And then at the Series A stage, the expectation in terms of ARR, revenue, EBITDA is like starting to change as well. So we'll kind of double click into more of like what the Series A benchmarks look like. But overall, we are still seeing when you're going from seed to Series A, like the net deal size for a seed company is still increasing, after 2021, because part of that is also a lot of these seed stage companies that would have raised a Series A maybe a year ago are starting to raise seed extensions. So that's where like you do see an inflation in net value of these deal size. Series A has experienced a pretty significant drop. We're seeing like the median deal size drop from in 2021 around over 10 million to now it went up a little bit in 2022 to 13-ish million, but then now it's dropping even more. And the number of Series A deals that are getting done has significantly gone down. But in terms of how you're thinking about which life stage you are, we definitely recommend thinking of it in terms of what that specific capital raise can do for you to unlock the next milestone for growth, because it's less clear about when a seed starts and when a Series A starts. So I'm curious, James, for NFX, like being a seed investor, like how are you thinking about, advising companies to navigate this trajectory from going seed to Series A?
Yeah, so we are also going through our own process. We've got a full-time person who helps our seed companies move from seed to A, along with the whole partnership. The goalposts have changed dramatically. It used to be that with 50K or 75K a month in revenue, you could raise a Series A. Now it's closer to 200, 400, 450. One thing we want to make clear is it's not a paint by numbers exercise. Like this isn't a vending machine where it's like, if I put in $1.50, I can get the Snickers bar, right, boss? We have to be careful not to, dumb it down to sort of kindergarten level paint by numbers activity. Each company is unique. What I will say is that when working with the VCs, you have to understand that they have a sweet spot, right? So they have a number, like Bessemer's number is like 6.5 million. If that's what you're raising, then that's what the partnership can most easily approve on Monday meetings. At NFX, it's like 2.8 million, right? And those sweet spots are actually published on signal.nfx.com, so you can actually see. So as you go to them, you should recognize that you have to understand what language they're looking for as well. And so this represents a spectrum, and I think this is really good work to show how this works, but it's all definitional.
Yeah. Yeah. What is a seed deal? Like, how something's categorized in PitchBook, is so relative.
Yeah.
And
6 years ago, a Series A would be, $5 million.
And there's always new deal types like extension rounds and series, A1, A2, A3. So it's very fuzzy.
Yeah. But I think the important thing is to realize there's a lot of pressure on the Series A now. On the seed, what's happening is, particularly in AI, everybody's having the same ideas. So we will get a deck. I think in the last week, we've gotten, 14 decks talking about the same sort of AI infrastructure thing. And one of our partners is really interested in this one company that he met first. But now as we're digging into it, there's literally, we've seen 14 in a week and a half. And that means that there must be 140. And so everyone's having the same ideas at the same time now, because we are in the startup industrial complex where it's now cool to be a founder and it's cool to be a VC. So now we've got 31,000, 40,000 VCs, and we've got millions of founders. And so you have to find a really unique idea. So some of the bigger seed rounds you see are when finally someone comes up with a unique idea that the VCs haven't seen, and then everyone just throws money at it, because at least they're going to be in their own zone where they have a chance to get some momentum. And you as an investor won't look like a fool because you invested in one of the 70 companies doing the same idea. So in November of last year, of 2022, we published an Excel spreadsheet with tabs for all of the different sectors so that the founders could see, I understand that you've got this great idea, and it is a good idea, but there are 70 other people with that idea. And when I would tell founders that on the phone, they would get mad at me. I've not seen them. I don't see them in the marketplace. You're just telling me that.
You've got a spreadsheet though.
Yeah,
And I was like, fine.
It's an open source database.
It's an open source database. Like, go to and the reason we published it, because we had been building the spreadsheet for about 4 years, tracking all the AI companies. We were like, they don't believe us. Just go to the URL. Just see the names, click into all the other websites. They use the same words you do. They're offering the same
buzzwords.
thing, same buzzwords. And so there's been such a flurry of activity around AI in the last year and a half that we've had to resort to this sort of thing to communicate to the founders. You got to come up with a unique idea. And you have to be looking and doing a lot more research into what other people are doing. And it's all moving very, very quickly. And so on to this point, and I'll finish on this, is that when you're talking to VCs, ask them, have you seen other companies doing this? What are their names? You know, you're not going to raise from most of the VCs you talk to. We invest in 0.4% of the companies we look at. So the chances of raising from us is very low. So use us as free consultants. Find out what else is going on in the market.
Yeah.
What?
Pro tip.
Yeah.
Yeah. Use us. Right? And present in like 6 minutes and talk for 24 minutes. Don't present for 30 minutes. You know, you have to be asking us because we see all these companies. They've all got the same plans. They all have the same buzzwords. They got the same ideas as you do. And you need to find an open space that people aren't in. You have to take that next step.
I think that's really key advice because if you think about the psychology of an investor, like they're all trying to make a bet in a specific space that they haven't invested in before. It's very rare that they're going to be investing in the same type of company that they've already taken a stab in. So I think it's, you know, very actionable tip here is like, as you are pitching to your investors, like do some research on who else they've invested in too. Like, are there similar companies to you? Because most likely if they've already made a bet in that space, they're not going to make two of the same bets, especially if they're going to be competitive. So this is our kind of textbook slide around just like how to characterize the different life stages between pre-seed, seed, and Series A. A lot of these numbers, to James' point, has shifted significantly. You know, like what would have been pre-seed is now probably the seed stage 2 years ago. And what would have been a great Series A now would have been an amazing Series B. So we don't want you to look at these numbers and commit them to memory. It's more around like, what are the different characteristics to kind of think about, you know, pitching your companies in terms of your round size. Pre-seed is very much like pre-product. It's all about the team. It's all about the people. You're not going to be getting institutional investors at that round. It's most likely going to be angels, friends and families, maybe a couple of early stage pre-seed accelerators, and you're not going to see a lot of dilution. At the seed stage, this is where like the expectation has really increased. It's not just about pre-product, no product market fit. It's about showing early traction that is going to be directionally pointing you to a Series A. And a lot of, you know, the cap table is going to be comprised of starting to add some institutionals, you know, seed investors like NFX. You're still going to have, you know, potential angels and individuals. And this is the round where things go from being unpriced to potentially priced if you do have a lead seed investor, and dilution is going to creep up a little bit more. I think the Series A mark is really, I was talking to one investor last week. It's kind of like the pass or no pass class you take in college. Like if you do get to Series A, it's going to be more around, you know, you have a significant lead investor, the go-to-market strategy, the product market fit is starting to become clear, and you're also going to have a priced round where you're giving away a board seat to your lead Series A investor, and dilution is going to creep up even more. But just recognize like the three different stages we're talking about here. What could be a seed AI company, you know, is a Series A size for, you know, a consumer or enterprise. So as you start thinking about the terminology you're using, really focus on more the characteristics of each of these stage instead of the numbers. And any specific, you know, commentary to add here, James?
No, I mean, you could rewrite this slide in a whole number of different ways.
Yeah.
I mean, you change some of the numbers, you could change the dilution stuff. It's all in flux. But yeah, I mean, one of the things that's hard, I think, for folks to understand is that I didn't understand this until I got into VC, you know, 6 years ago or whatever. But For Excel or for Sequoia, they can't really make any money unless they own more than 20% of your company. It's just the physics of it. And there have been a lot of seed companies that started out saying, we'll just buy 10%. And they've all the smart ones have moved up to 16, 17, 18. Everyone needs to move to 20%. And I hadn't realized what's driving that. And then the LPs are asking their investors, what's the percentage ownership? And if they say, well, our average ownership is 12%, they're going to be like, well, we know that math doesn't work because we've been doing this for 20 years and we've been working with the funds who are getting 20, 22, 24%, and their math actually works. They're our best investments. So we're not going to invest in you next time unless you get your percentage ownership up to 20%. So this is coming again and again. It's crazy. But the math just doesn't work because the frequency and size of the exits for the venture firms. And you're smiling in the front row, and you should be, because what it means is that the venture capital model, which has worked for the last 30, 40 years, is really under threat.
It seems like a natural kind of like point of tension between founders and VCs, though, because the founders want to keep as much as possible, and the VCs just want more and more and more. So,
well, what's interesting is the VCs don't. The VCs don't want more and more. The VCs want you to still own, 20 to 30% of the company as the founder. They just want to be able to buy their 22% and not have any other VC buy that, because they don't want you to be disincentivized with only 4% of the company. They don't want that.
No. Yeah.
And in fact, what happens is if you get to Series C and D and E and F, and the founders and the management team has been diluted down below 20%, the boards just re-up the founders back to 20%. So the rule is, and this has been the case since the 90s, when I first got into the business, is the management should always have 20% of, no less than 20% of the company. So that's just more dilution that the VCs experience. So they want you to have a capital efficient model where they can get their 20 to 25% and still keep 50 or 60 or 70% of the business yourself. That's the ideal thing for a VC. They don't want more and more. They don't want you to keep raising more money and diluting yourself.
I think that's a really key call out, because especially at the early stage, if you think about dilution, like a lot of founders are just doing significant stacking, a lot of, safe notes, like uncapped notes, and not really seeing like what's going to happen when they convert. So like that is something to think about as you set yourself on the venture fundraising path, is just like, how many investors are you adding in? What percentage do they own of your company? And like, how are you getting diluted every step along the way? Because we've definitely seen founders who just kind of like think about, oh, I'll just keep stacking my notes. And then before they know it, they're like, oh, this actually has diluted me significantly. And it's hard for another institutional investor to come in because their ownership stake is not going, the math is just not going to be yielding the right return. So definitely we recommend thinking about working with lawyers early on to think about your cap table structuring. And we're happy to introduce you guys to the right corporate and startup lawyers to really future-proof. This is.
Can I jump in here? One exercise that we have a lot of the founders do is do a spreadsheet and calculate the bounds of how much you're going to get diluted in your pre-seed, your seed, your Series A, your Series B before you exit. And say, well, at the best I can do this, at the worst I can do that. Like at the best I can dilute 10%, at the worst I'll dilute 15%. At the best I can do 18%, the worst I can do 28%. And do that for each of the rounds. And then see in the best case scenario versus the worst case scenario in terms of your dilution. And then say, I exit the company for 10 million, 100 million, 500 million, $1 billion, $2 billion. And what you'll notice is that it doesn't really matter how much dilution you end up having. What matters is how big the company gets that you build. It just swamps every other factor. And given that you're going to be raising money, even in the best case scenario, you're going to get diluted a bunch. Even in the worst case scenario, in the best case scenario, you get diluted a bunch. But still, it doesn't matter if you only sell the company for $10 million. So I raised 9 different venture rounds as a CEO, and I always took the lowest price from the best investor. And I have way more money than I need. And all these people are my friends because they're quality people. And so, the honest frustration with a group like Y Combinator is that they say that the investor doesn't matter. And my whole life, since the 90s of being a CEO, has proven exactly the opposite. And so I think that's bad advice for founders.
Investors matter.
Yeah.
Yeah.
Investors matter a lot.
And
And investors can kill your company. We have, I don't know, I would say we've got 180 investments. I would say in the last 6 years, we've had 5 companies where another investor killed the company. The company was fine. But the investor's behavior, their psychology, the way they moved, killed the company. 0 for the founder.
Yeah, this is a long-term marriage that you're entering in. So definitely do your due diligence, not just on the pricing, the term sheet, but also on like the human characteristics, how investors are going to be maneuvering during hard times.
It matters so much more.
Yeah.
Because what you're going for is the big outcome. That's going to matter a lot more to your pocket than your percentage ownership.
Mm. Yeah, it's really good to look at a portfolio of an investor, see how like some of the companies that see all of their companies too, not just their wins. I think I've had friends whose companies have been destroyed by an investor like merging their perfectly fine company with a portfolio company in their portfolio that was failing to make it look better. And then that company that's okay just gets like sacrificed. So look at an investor's hits and misses and what some of those misses were. Was it the company doing something wrong, or was it the investor making some creative decision?
Yeah. This is where back channeling comes in.
Yeah.
As you start
Ask around
to get your term sheets, really make sure you talk to other founders who have taken money from these VCs.
So yeah, these are just some really rough benchmarks of, revenue at Series A. Again, not a paint by numbers approach, but also looking at, I think it's interesting to break things out by sector. On the frontier tech end being the lowest, hardware is hard. It's a really tough space to be in, and it's very capital intensive. There's not a lot of revenue early on, and it's not until, things scale and you get some big contracts. Enterprise and consumer software, scale a lot faster. So I think it's interesting to kind of break things out by sector and see where you are, benchmark yourself to other as similar a company as possible that you can get comps for, because things, when you're looking at things in the aggregate, that's definitely not going to apply to, you if you're a hardware company, for instance.
And again, just to James' point, like this is not a paint by numbers approach. Like these are all, average numbers in terms of revenue, but like what is going to make a great Series A company for one investor may not be the same for another. So thinking from a scorecard approach is actually going to be very reductive instead of thinking about how do you pitch your company uniquely to each VC. So kind of diving more into like the tactics, the how of fundraising, the general framework we like to lay out is making sure that you understand what the timeline is going to be for your fundraise. It used to be like if you raise a seed, you could budget 4 to 6 months. Now it's more like start thinking about it like 8 months, 10 months in advance, because it's going to take longer to raise in a down market. So kind of working backwards on like, what is your current runway? When are you going to run out of money? And like, when do you want to start that fundraising process, buffering for a much longer period? So now we're looking at average seed rounds, taking 12 to 16 months even for certain markets. So just understand that it might be an evergreen fundraising process as you are closing your seed. Start having those conversations to position you well for your Series A with other investors. In terms of knowing the actual metrics and what are the materials to position you, this is where we see a lot of founders falter, is like they rush at the very end to build out their financial model. They want to kind of like focus more on the company building. Like the financial model is something that you want to be keeping evergreen as well, so that your numbers, your data room is accessible as you start having these conversations with potential investors. And really thinking about this, I think, as more of an evergreen process where like you are meeting investors now that you may want to be pitching in 6 to 12 months from now or in 2 years from now. So keeping those relationships warm is super key. Don't just hit up James when you need money, like actually get to know his thought process, read his writing, respond and share insights. Like I've seen some really amazing founders through their investor updates just keep VCs top of mind in terms of here are some interesting developments. Here is how I'm seeing the market. So making sure that those relationships are warm is going to also help you reduce the timeline for fundraising. And the last piece is just making sure that like all your existing materials, your fundraising, your data room, those are very well organized and clean. So as you start having prospective investor conversations, you're not scrambling and gathering all your materials. So this is just kind of like the prep process before going into a raise. Specifically how you should be thinking about the fundraising funnel here is kind of like where we give an analogy of like similar to enterprise SaaS. Like you want to be as a sales rep, like think about how many leads do you want to be pouring into your bucket? Like how are you thinking about approaching those introductions and also refining and iterating your pitches? So we always recommend in terms of, you know, however many companies, investors that you want to be pitching, like create a spreadsheet for yourself so that you're able to stack rank those VCs and think about the order of operation in which you're pitching, because someone who is like a Sequoia, an NFX is best saved for those later conversations as you start to, you know, practice your pitch with more of the friendlies, like the angel investors, the friends and family, so that you're really able to kind of like make your mistakes early while it's still cheap. But just recognize that like the fundraising process has to be a very operationalized like sales funnel. Like you are going to have to run a process that may start out with, you know, 100 investors on this spreadsheet and work your way through. And it's important to also think about where you are on that kind of life cycle of those conversations so that you're able to map out, like, is this a first meeting that you're having? Are you moving on to the second cycle? Because we're also seeing in a down market, like a lot of founders are pitching to funds that may not even be active right now. And that is taking up a huge chunk of their time. So know that you are working towards a yes and a lead investor, but also make sure you're managing your time working through that process. I'm curious, James, in terms of like how you recommend planning for the fundraise, like do you have a specific approach or kind of advice for your founders to think about the process?
Yeah, I mean, again, this is why we built the signal.nfx.com tool is you can go in there and you just flag a bunch of the VCs that you're interested in talking to, and then you go to your list and just export as CSV, and then you just put it in there. And then you can manage it through that. And I would do it on a Google spreadsheet so that you can send it to your advisors and say, who wants to introduce me to these folks? And then they all compete to say, oh, I can introduce you here, I can introduce you there. It's a great way to take all of your advisors and investors and get them making those intros. Intros from CEOs are better than intros from VCs. Your investors are selling their book, and so the other VCs are skeptical of them. But a CEO is like, oh, the CEO is great, and the VC feels like they have proprietary deal flow, and they get an email from a CEO telling them, I really like this other CEO. That feels very more special. They'll hop on that faster. I think there are VCs that need warming up, like a Greylock, a Bessemer, a Battery. These sort of East Coast investors with the DNA of the East Coast, they take a longer time to warm up. But if you're talking about an NFX or a Sequoia or sort of more of a West Coast mentality, we can meet you on a Wednesday and give you a term sheet on a Monday. Like that's the way our system works. So you don't need to constantly be like warming us up, and we can't remember who you are because we're looking at 8,000 companies a year. So when you come in, we just like, here's the deal, here's what we're doing, blah, blah, blah. So that's another thing to look at. And, managing the spreadsheet on a daily basis and having different PowerPoints for all of your investors. At the end of my fundraisings, I would have 80 or 90 PowerPoints.
Like different permutations.
Yeah, and different permutations for each of the individual investors, because I know from their writings what words they use in their fund to talk amongst themselves. Because remember, you're not just trying to sell one person who's going to be on your board. You're selling the whole partnership, because they've got a minute and a half or 2 minutes to sort of sell your deal to the partnership on Mondays. So you've got to have just the right words and just the right approach and the right sweet spot in terms of the amount that you're raising. That's what gets it over the line eventually. And if you've developed a really strong personal relationship with one VC, you haven't with their partners. And the one VC can't take all of their political chips and say, no, we have to do this deal. Like, it doesn't happen very much. It has to fit in with what the partnership is looking for. So constantly be working on the spreadsheet, and constantly be changing your PowerPoint. Typically, we'll have 8 slides in the deck, maybe 12, no more than that, so that you can get through the pitch in sort of 6 to 8 minutes. And then you'll have maybe 60 or 80 slides in the appendix for all the questions. And then you just go click, 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 and you go down to slide 64 to answer the exact question they have. And one person might use this word to ask for it, and so you need to have the title of the slide be those words. And if someone asks the exact same question, but they use different words, then you have different, and so you have different appendix slides for all the different language that people use, because otherwise it's too hard with all the volume for these venture firms to look at to actually make a decision.
Sounds like we need an AI model that ingests all the language of all these venture firms and then helps you spit out bespoke PowerPoints for all of their niche.
Tome is generative AI powered deck, creation, but we need to hook it up to an FX specific model, a Sequoia specific model. And I think this is where the learning piece comes in, is like, as you start to pitch, like, there's a lot of information out there that these investors put out, especially NFX, like you guys are the second most trafficked content site. Like, the thinking of the investors in which the language in which you should be pitching to them is out there. So even thinking about yourself as how am I going to create an AI model for James? There's a lot of content and language that you can use to customize that pitch. And we always recommend reading up on what investors are sharing. So much of the content marketing of a VC is sharing their thesis, how they see the world, the perspective in which they're investing in, and really think about ingesting that so that you're able to create the right specific presentation. And know that every investor is going to be ingesting your deck in a different way. Some folks might want to meet you in a coffee shop, no slides, just be able to riff with you on a deep philosophical discussion for 30 minutes. Other folks may want to just dive straight into the data room. So having that agility, the kind of neuroplasticity of molding yourself to what the investor wants to get out of that meeting is also important.
And it's not a waste of your time, because these are smart people who aren't necessarily smarter than you, but they see a lot more deals than you do. Yeah. And so when you adopt their lens, you're actually learning something. If you're changing your language, you're actually learning something every time you go through that exercise. So it's not a waste of time to do this. It's not just to get the money. And again, if you go into a bar and you want to pick somebody up, you don't just say, "Hey, let's go to bed." What you do is you talk to them and you learn about them, and you have an interaction. And you got to do that with these VCs. You can't just be like, "Give me the money." Yeah. If you're not going to give me the money, I don't care. That's not doing you any service, and you're not getting an opportunity to learn. And so as she was mentioning, so Andreessen Horowitz has the most trafficked VC website in the world, and we're number 2. And it's because of all our content. So if you go to nfx.com and you click on content, and then you click on fundraising, there's all these articles that explain stuff about how you should be standing up during your meetings when you're pitching. And there's all sorts of tactical things you can learn about this stuff. That's all there for the reading.
Great. So then thinking about moving into the pitch phase. So we've kind of touched upon how you should approach kind of the narrative storytelling of your pitch. A lot of what we're seeing, especially in the seed stage, is being able to paint a vision for the type of company you're building and talking about the total addressable market. Is this a large enough market size? This is a mistake we're seeing in a lot of the pitch decks, is there's just not a big enough market size for a venture backed company to really tackle. So these investors are not going to be investing in you solely because you have an amazing solution. They're also thinking about what is the total addressable market? Is this bet potentially going to return my fund if I'm going to invest in 100 companies? Is this the one unicorn? So really thinking about, not just like the numbers, but also the size and opportunity at the seed stage is really critical. At the Series A, you really do need to know your numbers a lot more, and having different kind of scenario planning for like how you are projecting your burn, how you're tracking towards revenue, towards EBITDA, and like being more of a, I would say, like conversant to like a spreadsheet investor, like someone who's going to be investing you based off of your numbers, since like the actual like product market fit is starting to become more clear. But in general, in terms of your presence of how you are pitching to investors, like thinking in terms of showing up as your authentic self, like knowing your specific expertise, like really selling them on like why you are uniquely positioned are just great practices. But I would also, recommend, like, as you start to like try these pitches over time, like learn to iterate on feedback. Like what works for one investor in terms of an amazing pitch may not work for another. And I like how James pointed out the different cultural divides too between an East Coast investor versus a West Coast investor is really key too. So when you do go fundraise in New York, there are a lot more investors who come from a traditional finance background, and may be needing to see the data room and the financial model up front before they even take a meeting. Whereas like West Coast investors, like it could just be like you have a really moonshot idea and they want to be like having more of an intellectual conversation. So also know like which style of pitching better suits you, and tailor yourself to that specific market or investor. Are there any other takeaways?
Yeah, so another thing is you guys are salespeople. You're selling your product to the market, and you're also selling your stock to investors. You're actually running two businesses. And the amount of time you spend on your sales pitch to your customers with your deck and the process and the go-to-market and all that stuff, you need to bring maybe 40% of that effort to the VC side too, but it's a big effort, and to talk to your customer and to learn from them. I always, as a CEO, had a deck ready to go, because I would put it out in front and then I would just ask them questions. And this would maybe be a year and a half before I want to raise the next round, because I want to see it through their eyes and they can actually help me make the business better. Oh, I didn't realize that. I didn't realize that Google was doing that now. And so I can't go at it that way. And then I have a chance to go back and change the product. I have a chance to go back and change my customer base. I have a chance to go back and change my margins, so that when I do need to fundraise, it goes much more smoothly. And this is why, we never failed in our 5 companies, is we were always ready and always talking, and we were evolving the product to what the customer wanted, and we were evolving the company to what the investors were seeing. Not because I need to form fit my life to what the investors want, but because the investors just saw so many more deals and they had more insights. And I would take their best insights, and I would take my competitors' best insights, and I would take my customers' best insights. And that's why we never failed.
And I think this is also key to like thinking about what is shareable information and what's not. Is like a lot of founders are asking upfront, like, can you please sign an NDA? And it's like, for an intro call, like there's really nothing that proprietary that for you to hide from an investor. And these are opportunities to be sharing like how you're thinking about the company and getting feedback from these investors. So it's kind of like thinking about, how do you solicit market feedback? Like you want to be soliciting investor feedback and understanding the psychology of investors, so that your product is an MVP, but also your pitch deck is also an MVP that's iterating through time. So those conversations, are really not as confidential and proprietary as a lot of founders think they are.
No, I have never signed an NDA ever once.
Yeah.
And if anybody asks me for one, the conversation is over. It's just, you're not part of our culture.
Yeah. Great. And then in terms of, this is more like managing the psychology of investors, like thinking about how you build momentum. Like there's always so much more activation energy that's needed to create traction towards a lead investor. But once you do have that first term sheet, every successive, pitch is going to be a lot easier. So I always, want to kind of like caution founders to think about this is like a sequential approach. It's more like it's very hard, like use the 80-20 rule until you get a lead term sheet, because you're essentially trying to generate as much FOMO as possible for every investor that you're pitching. So as you are having these conversations, it's important to keep them updated to show that there's really heat in the round. And I think this is like the under kind of like estimated part of fundraising, especially first-time founders go into, is like you have to generate enough velocity and momentum in your round so that there is like a founder whisper network. There is an investor whisper network. As you are pitching, investors are also going to be saying, hey, I'm looking into Liz's company. Here's some interesting things. The founders in which they've invested in are also able to say, hey, your company is interesting for XYZ reasons. So I really think it's important to like think about the soft skills of fundraising and generating the momentum and the kind of like velocity of a raise as it is for the hard skills of like the content. But I guess with NFX, like where do you guys fall on that spectrum of like FOMO to having to, create that social engineering effect to get the lean term sheet?
Yeah, it's a tough balance. I think that it's a very tough balance, and there's a lot of nuance to it, and I don't think you can understand the nuance well enough to actually play it perfectly.
Yeah.
I think you have to be aware that there is a sense that, at some point, one of the partners will ask me, well, how long have they been fundraising? And like, oh, they've been at it for 3 months. And they'll go, well, then, that's not a hot deal.
Yeah.
And then I have to be able to answer that, or they'll say, well, are they talking to someone else? And I'm like, well, they say they're talking to, 2 other multi-stage firms. And then they'll say, well, they don't get it. They shouldn't be talking to multi-stage firms. They're just seeds, so we shouldn't invest in them. I mean, there's all sorts of little funny nuances to it, but I don't think you can play it perfectly. What I would say is that don't overdo it. Anybody like an NFX or Sequoia is going to smell that and be like, yeah, do whatever you want, dude. Like, go play your little Y Combinator games and, lie in your deck and try to like just think that the whole thing is FOMO and we don't care.
Yeah.
The best investors don't care. We always lead, we never follow. Sequoia always leads, they never follow. They don't take a little piece, we don't take a little piece. The best investors are just going to be like, okay, if we want to do the deal, we'll do the deal. And if we don't, we're not going to be influenced by somebody else. Now, if you have a timeline and someone's giving you a term sheet, and we know that you probably have 7 to 9 days before it becomes really uncomfortable for you to keep pushing that person along. So we will rush up. We will push other things aside. But we do that as a service to the founder, not as a thing where we need to run to catch up. I mean, not as a thing where we're trying to do it for ourselves. We're doing it just because we know the founder's in a bind because we've been there ourselves.
Yeah. So yeah, I think there's like external pressure to speeding up the due diligence process. And there's also like internal pressure of like, this is a really exciting deal. I'm excited about the founder and we want to be the first check-in. And I think that's also important for you in your conversation to really think about like, is this investor going to be like a first check-in, like high conviction investor, or is this going to be someone who we're hearing this a lot more of like, I will invest if Sequoia's in. There's a lot of conditional yeses. And that's where you really have to tease apart, like how convicted is this VC to participate in this round versus fast follow.
Yeah, so we'll get an email that says, we're raising a $4 million seed and we already have 3.2 million circle. Do you want in?
Soft circle.
Circle.
Yeah.
Do you want in? And I'm just like, delete. It's like, we only lead. If you're doing a $4 million round, we're going to take 3.4 million of it.
Yeah.
And we'll bring in the best angels to fill out the rest of the round. But that's our style. There's another venture firm you could go to. They're like, perfect. We invest $400,000 and we'll get the last $400,000 of this $4 million round. And that's perfect pitch for them. they're like a momentum follower, and you can cobble together around doing that.
Right. So this is the part where we want to start also helping you guys think about non-dilutive sources of funding, because as you are pitching VCs, you're also able to kind of parallel path and think about, when does venture debt make sense for you? And this is where SVB works very closely alongside other investors, especially in the due diligence process. When we look at a company, we are essentially running along with the VC's kind of due diligence process to think about, is this a company that we could potentially underwrite a venture debt deal? And the way we think about, venture debt is, this is non-dilutive funding that's going to help you increase your runway, but you do have to make sure that you're continuing to fundraise down the line. So it's important to really approach the venture debt process from a position of strength, not when you're running out of money, not when you don't have product market fit and you don't think like you're able to close the next round. It's more of a additional add-on as you are starting to close your round. And this is the part where we do recommend having a conversation with a banking partner like SVB as early as possible, even at the seed stage, because it is important to think about how you're tracking towards Series A that could help you unlock more of our venture debt offerings. As you start thinking about the venture debt process, you want to be thinking about it similar to how you're choosing your right investor partner too. Make sure, just like your lead investor, you discuss the pricing, the valuation of the round, like how you're also going to be using that cash to unlock the next phase of growth. We do think about venture debt as something that is about 20 to 30% of your existing round. So as you start having those term sheets, it's really important for you to parallel path that with the SVB side. And it's important for you to really think about, if you are a banking client of ours, or if you're curious about venture debt, have that conversation as early as possible, because we ideally would want to be closing the venture debt round around the same time as you are thinking about closing your term sheet too. So this is where, having key relationships with VCs like James and other investors really help us see the potential of your company as you're fundraising, instead of traditionally looking at debt from more of a perspective like, what's your current P&L and what's the financial model of your company. And I'm curious, James, what is your take on venture debt and how you really think about advising companies to use debt effectively as they start to raise more equity?
Yeah, I think the slide with the big X and the check mark is good, because there are situations where you really don't want venture debt. We've had several companies that raised venture debt and it killed them. Mm-hmm. They could have had flexibility, but they didn't once they took the debt. So we are typically thinking about it post Series B.
Okay.
The conversations, we encourage them to explore opportunities, but for us, our advice is typically around post Series B, when there really is product market fit and you really have predictable revenue, and you're not putting yourself in a situation where you're going to risk the company, or getting a $12 million exit or a $6 million exit or a $40 million exit, which you could have had, except that you took the debt and the clock was ticking and you had to get out. So I think for very unstable companies, I think debt is dangerous. And I think for much more stable companies, it's a fantastic accelerant.
Yeah. I think that's where it's approaching it from a position of strength is key. Is you want to be thinking about venture debt as your company is growing, as you're raising more money, and that gives you a little bit more timeline to grow into maybe the next valuation that you want before you go out to fundraise. But if you are struggling, that is not a great time to be taking on venture debt. This is the time, where we also want to turn the conversation around to you guys as you start thinking about how to tactically fundraise for your next seed to Series A. I'm curious, how many of the founders are right now currently in the raise process? Okay, we have one. And also, how many of you guys are planning to raise a Series A in Okay, great. So I'm going to open up the room for more questions for James and myself and Liz to kind of really help offer more actionable guidance around the fundraising
We
process.
might have one on the line too.
Oh, we might have one. Let's see on the.
We have a virtual.
We've
We have
got
a
a
virtual
virtual
audience
question.
too.
Oh, great. Awesome. So we have one question from Jason, which is what's an example of a question that different investors might differ in their language? Like, are you talking about go-to-market versus sales motion versus customer acquisition, for example, or is this something a little bit more esoteric?
It's a great question. It ranges all over the place. Like, some firms, they like B2B2C or they like B2B2B, but other firms don't like it because they think it's too many steps. And if you come in with language saying we're a B2B2B company and the firm doesn't like it, then that's language that just won't fly. And even if I think what you're doing is great and I think you're a great founder and all that, I'm gonna know that my partnership just won't take a B2B2B company.
Yeah.
It's not true with NFX, but I'm just saying that's one thing that gets sticky. Or, for instance, people come to us and they say, here are the network effects that we think we can build. And here's how we're starting to build them. That's very powerful for us. And then when we take that and we invest, we put in our $3 million, and then we take it to a Series A firm, and they're like, what are you talking about? They don't understand the power of the network effect yet. That's not part of their language. So what they're really interested in is some sort of ratio, some sort of SaaS sales ratio that is more important to them. And so we have to make sure that that's the language you speak.
Yeah. And also there's a lot of shared information you can get from other founders who have pitched these funds, especially if you're in founder networks and forums. Like there's always a lot of, kind of like insider information that you can learn from folks who have spoken to specific funds. And also think of funds too as a partner level, like individual specific type of relationship where like just because you pitch to James one side doesn't mean you pitch the same way to Morgan, for example. And like these are all individuals who may see the world differently. So it's important for you to kind of be able to like take your NFX hat on and off as you talk to different investors and kind of compartmentalize each pitch that way. Any other questions that we can kind of go through? Yes, Surya.
Yeah, I mean, you have to identify who the people are using LinkedIn or press or friends. And then once you get their name, what's that? Okay. Or then you have to start networking into folks and just find out who's in charge. And then you have to figure out how to, get that email to be short enough and your deck to be short enough, not to reveal too much, but to be interesting enough so that someone will pick up the phone. Often one of the things that happens with top investors is you can come in at the CEO level at Square, or you can come in at the SVP level right at the top, and that shortcuts the conversation, which is, it's an unfair advantage that the better companies get because they get the better investors and then they get the better access to those sorts of things.
Yeah.
It's always the chicken or egg. That's right. That's right.
Yes.
So talking to a lot of other. That doesn't fit what we do. I mean, we've got a staff of 40 people who help. Who help the companies once we invest. We meet with them weekly. Like we are very involved with all of our companies. So we aren't just putting in $600,000 checks or whatever following. So we don't participate in rounds like that. Typically, if you're raising $4 million, we'll put in 3.2 or 4, and then there'll be 600 for other angels, and then we'll meet weekly, and that's our model. I think the party rounds, as we call them, have been dangerous since the 90s. They continue to be dangerous. I think it's bad advice. I think it's driven by Y Combinator's desire to be the only sort of important brand on your cap table. And their business model is to arbitrage their 10% that they buy in you for very little, telling you that your valuation will be high enough so that your dilution will be the same. And so in order to get the highest valuation of like 25 million, they then have to have party rounds with people who aren't necessarily sophisticated typically. And so I think that's been a lot of, and then because they have such a number of companies throughout the ecosystem, I think that that is permeating the mentality of a lot of the founders. I don't see that's where the biggest companies come from. Just traditionally, you traditionally have a really great investor like a First Round or a Floodgate or a, or a Pair or there's lots of really good lead investors who are very value added, who are not NFX and whatever. And when you have that type of round, that typically indicates that the company is going to have a higher rate of success and a bigger success.
Like it's a 1.5 pre-seed round?
Not necessarily, but some of the best companies do have a $1 million round from an NFX as a pre-seed or a Pair or somebody. You will see some of the better founders in the better markets have that even at that level. Yeah.
So just to kind of repeat the questions for our online attendees is the question is more like in a early stage market today, like, do you want to be in raising more from individuals versus institutionals? And a lot of founders are right now doing party round, which is like a institutional led round where you have a lot of individual angels. And also one thing to add about party round, I think it got very trendy like around 2021 when the market looked really good. But if you think about, when there's an adult in the room and something goes wrong, this is where your lead investor comes in. And we've seen companies that have shut down since raising in the peak of the market in 2021 when they became in distress and it wasn't clear who out of the 50 individuals was going to step in and help them. So I think this is where having a well-seasoned investor like James on your cap table who has seen the different markets go up and down, like is important to be able to step in and be kind of the authority in the room, so to say, like when you're in crisis.
And it's not just NFX. There are really a lot of good investors who can be very value added. We're not just pitching NFX. What I will say is founders are trying to figure out, how am I doing? Am I doing this right? Am I winning? We all are as we go through our daily lives. And when I was thinking about it as a founder, I was like, am I getting the right people around me? Am I building the product that people want? And because we are living in this startup industrial complex now with 31,000 VCs, it's moving to, am I getting the highest valuation? Am I getting the least dilution? And I think that's a mistake. I think you should judge your success by who you're getting around you and whether your customers love your product more than you should judge it by how high my price is. And I think you should coach all of your teammates, the people who work for you, to see it the same way. Because they're trying to judge you. How is my CEO doing? And you feel that pressure, and you feel it from your spouse. And they're like, well, did you get the highest valuation? Does that mean we're succeeding? How are we doing? Are we going to be okay? And you have to say, no, we're going to be okay because we have Mike Maples on our board now. We're okay because we have Pair invested or whatever. Like, it's a different mentality.
It's less the TechCrunch headline and more like, are these the real people who can help you in the long term?
Yeah. Like what's under the hood of the cap table?
And then we're going to end on one last question from the one of the virtual audience members is, this is a question for James. Like, what's your take on corporate VC at the seed stage, especially if there is a distribution or channel advantage for the company? Do you like them on a seed round that NFX co-leads?
It's a great question. We don't mind, but the details matter a lot. The details matter a lot because what the corporates are interested in doing is basically buying you without buying you. And that's the short end of it. They'll try to stick in a first round right of refusal. They'll try to stick in a this or that. And it's not that they're evil. It's just that's what's in their best interest, to give them option value and to reduce your option value in the relationship. And when you have a VC like us, our whole thing is to give you option value. We want our contracts to be as simple as possible. We want the funding to get done as fast as possible. We want you to have as few people on your board as possible so that you can just make decisions quickly and not get involved in all the politics and the bullshit. Whereas the corporations, they kind of care about investing in you, but really they care about their share price, which is about owning you long term. So it has to be done delicately.
Yeah.
And if you have a PayPal on your cap table, what does that mean about the other potential acquirers? Are they going to assume that I shouldn't buy this company because PayPal knows all the information? They might think that.
Yeah, I think having worked at a CVC before at Samsung, like I think it is important for you to also think about what that specific CVC's mandate is. If it is to help the parent company think about innovation, then similar to like an Inflection AI, like Microsoft acqui-hiring that team is going to help the agenda of the parent company like further their longevity, versus if this is a CVC that's investing from their own LP base, like a Bloomberg Beta, like that is more of a like independent CVC fund financially.
Yeah.
So I would think about like where that CVC is falling in relation to the parent company, if this is independent versus if this is going to be more of an innovation arm that invests through potential acquisitions and partnerships.
Also plug for SVB's CVC report. We have a
Yes.
massive CVC report that goes through all of this in very extensive detail.
Yeah.
So
And where do we find that?
svb.com, if you look up state of CVC, I think we're the only, we do it in partnership with Counterpart Ventures. And I think we're like the only CVC report out there. So that's the report that we get the most like inbound inquiries about, because it's just like, when you Google state of CVC, we pop up.
Yeah, we'll make sure to include that link in our recap email. So
It's really great to learn about, like, if you're a founder, like you may think like, oh, I don't care about like what a state of CVC report is, but if you're going to get investment from a CVC, it's really important to like dig into these investors and know what makes them tick.
And the thing that can be deceiving is that the people you interface with are wonderful people. They're good people. They're trying their best. But the corporation behind them has certain requirements.
well, thank you so much, James, for your insight, your time. And we'll also be sending out our new State of AI report. That's going to be published later today for you guys to take a look. But this is really just one of many events that we're doing as part of our AI series. Like, we want to make sure that SVB is supporting the future AI founders of today and tomorrow. And as part of our event series, we're actually hosting an AI showcase in New York on April 11th, specifically connecting AI companies with corporate buyers. So these are just kind of the types of access to other ecosystem players that you get working with SVB as a banking partner. And we want to be here as a resource for you guys to really think about how to harness the most out of our AI builder founder ecosystem. So feel free to ask us any questions afterwards. And we're super excited that you guys could come out here. And it's great to host such an amazing event in this space. So thank you all.
Thank you.
Yeah, thank you.